Starting with a brief history, most of the evolution of modern finance and investments is based on the theory of utility, and that we are utility maximizing individuals. And from the theory of utility, which is a rational theory, as we'll see, we we developed the modern portfolio theory that you may have studied in your investment class if you have taken it already, or you will when you come to Business 593. That's modern portfolio theory. Along with that, the development of the hypothesis of efficient markets, the efficient markets hypothesis, which essentially says that only the future matters. That's where your benefits are. For anything you purchase today, your benefits are in the future, so only the future should matter. And that's the efficient markets hypothesis. So that's sort of the foundation for modern day investments, essentially modern portfolio theory and the efficient market hypothesis. And for the longest of times, money managers and people who manage money at mutual funds and insurance companies and so on, the only argument they could sort of provide against efficient markets, that you really couldn't predict the market, that's the underlying basis of efficient markets, is that, well, if you can't predict the market, how do you explain anomalies? And anomalies like like the crash of 1987 or the small firm effect and so on. That's what money managers would argue, is that efficient markets imply that anomalies would not exist, and it was a very ineffective sort of argument, because essentially the academics would say, well, that's the reason why we call them anomalies. Duh. It's like, anomalies don't explain or refute anything. They basically tell you that these things exist without any understanding of why they persist. But they don't refute that markets are efficient or that modern portfolio theory doesn't work. So this argument would not work well in the past. But sometime in the 70s, a new line of work began in the field, both in the field of economics and, interestingly, in the field of psychology, financial psychology, and it culminated in 2002 with the Nobel Prize being shared by two professors. One was Professor Vernon Smith, and he's an experimental economist. And I'm sort of lucky to have worked under him when I was a PhD student in Arizona in his experimental labs doing behavioral finance work, and that's where I started getting interested in this stuff. And Professor Daniel Kahneman, he's a psychologist, and he's out of Princeton, and he and another professor called Tversky, and we'll come to them, provided a theory that we'll look at in some depth. Now, Vernon Smith and Kahneman are not what do you say? They're not money managers. They're professors. They're mainstream academics. So what they were saying was being supported by very hard evidence, which could not be refuted by the efficient market folks like Fama and French and Miller and Modigliani, all the academics, who supported this notion of theory of utility, modern portfolio theory, efficient markets, and so on. But now, along with the two or three pioneers, all sorts of academics have sort of jumped onto this bandwagon of behavioral finance. So today, there's a tremendous amount of information that's being produced in this field. And the person who's sort of leading the charge out here is a person by the name of Richard Thaler, Professor Thaler. He is now at the University of Chicago, and I'll come to that in a moment. But all these other names that we look at, Sheffrin, Hirschleifer, Statman, Dean, these are all very, very well-known finance academics in prestigious universities around the country, where they're in Stanford, and in Chicago and in Harvard and in Michigan, all the big schools. So these are mainstream academics who are providing evidence to the contrary, to the contrary of efficient market hypothesis and MPT, saying MPT and efficient market hypothesis does not work. It's a really serious challenge because these people are not money managers. They can refute the evidence from EMH or provide evidence to support that rational theories do not work. And that's what's been happening. And the person who's championing the efficient market hypothesis is also an academic. I think some of you may have heard the name Eugene Fama, or Fama in French. And Fama is your efficient market hypothesis proponent. He's the sort of the guy who sort of proposed this hypothesis of weak form, semi-strong form, strong form efficiency in the financial markets. Now, Fama was in Chicago, and Chicago recently hired Taylor out of University of Wisconsin and Madison in the same department as Fama. So the two big guys on the two sides of the table are both at Chicago, and sort of the irony was that Taylor was hired at a higher salary than Fama, which didn't go down well with the rationalists. And so there's a blazing row going on in academia, in financial academia, as to who's right. And from the point of view of Fama, I mean, he was this close to a Nobel Prize, and this behavioral finance is sort of putting a sort of a damper on his ambitions, but it's not going away. But he's fighting tooth and nail, and he's also got his cronies like Miller and so on, the other people, Merton and Miller and so on, for supporting him, saying no, markets are efficient. So we'll take a look at that. So that's basically the history of how this has come about and where it is today. So the theory of utility essentially is what we call what do you say? It's a theory of how people should behave or how decisions should be made, and it's known, and that's sort of, it's the understanding that if markets are efficient and if modern portfolio theory works, then rational investors would make decisions based on their risk aversion. You've learned about this, and so essentially the asset allocation that comes out of modern portfolio theory and efficient market hypothesis is a utility maximizing behavior of individuals where they look at the future, they look at the future benefits in terms of cash flows, find the present values of those cash flows, and then figure out using correlation, etc., what's the best portfolio they can have. So this is a theory of how rational investors should behave, all right? And it's based on risk aversion. Now, risk aversion, if you remember, I think you might have taken Harry's class. If you have taken Harry's class, you might have mentioned about, you look at that the distribution of returns is normal, so that if you knew the mean and standard deviation of a portfolio, that's all you needed to know. So risk aversion is based on mean variance efficiency, all right? And what that allows us to do in finance is that if you assume that that's true and that the distribution of returns is normal, what it allows you to do is to introduce calculus into the asset allocation. So asset allocation is all about using calculus to find the optimal portfolio, as you may have seen in the class, in your Business 593 class. But it also makes it very complex. It makes it so complex that very few people understand how to put this optimal portfolio together. It sort of builds it into a club. So the idea that we are rational, we make decisions based on our risk aversion, we cannot use the past, we only use the future, leads to this asset allocation, modern portfolio theory. That's how we should behave. But the theory that's coming out of the other side from behavioral finance is not how investors should behave, but how investors actually do behave. So the difference is between, I think it's one is called positive theory and one is called there's some I can't the term is eluding me, the proper term. How people should behave and how people do behave. So the prospect theory that was proposed by Kahneman and Tversky in their seminal paper in 1979 basically put together as a theory of how investors actually do behave, not should behave. Uh, Tversky did not receive the Nobel Prize because he passed away before 2002, and you can't get the prize posthumously. And their theory is based on the idea that we individuals are not risk averse, but loss averse. We are not averse, but averse to loss. Excuse me. The distinction is this. When you talk about risk aversion, you basically, and you look at standard deviation as the measure of risk, then there's two sides of risk, an upside of risk or and a downside of risk. Standard deviation is both sided, two-sided. So you have an upside of risk and a downside of risk, which means shocks from the expected. So we are averse to the unexpected. And what Kahneman and Tversky suggest is that we are only averse to the negative unexpected, not the positive unexpected. We are averse to loss. So we are not averse to unexpectedly making a lot of money. We are averse to losing a lot of money or some money unexpectedly. So we are averse to loss and not to risk, which really makes sense if you think about it. And if you do that, however, think about it, you can't use standard deviation. So we are taking away the underpinnings of modern portfolio theory, which is why all this sort of about behavioral finance not being right, etc. Because that whole theory, that whole idea of modern portfolio theory goes away. And here's an example of how loss aversion would work. Suppose you're playing a fair game, like a coin toss game. That's a fair game. A fair game is a gamble because the expected return is zero. Suppose this is a game that you're playing, and if you call it wrong, if you lose, then your loss is going to be $100. Now, if you were to play this game, how much must you win to be able to play this game, right? So that's the question. For a loss of $100, how averse are you to a loss of $100 such that you will gamble, which is a coin toss game with equal outcomes, right? The expected return is zero. In this example, on experiments that people have done, they find out that if on an average or an average person, if they could win about $225, they'd be willing to play this game, where if they lose, they'd lose $100. So an approximate index is 2.25, but a point of note, as soon as you start measuring the loss aversion index, you're also introducing numbers. So you can't really move away from numbers in finance. They're sort of intrinsically connected to each other. I think I'm looking at the camera right now, so I'm looking at you. And I hope it's still pretty cool to have this, be able to see your instructor. Okay. All right. So what are the implications of prospect theory? That we are averse to loss and not to risk. What it basically sort of brings out is that we may not be making decisions which are that rational, where every time we make a decision, are we really looking into the future, looking at our benefits, discounting those cash flows to find present values? Are we really doing that? Or are we making decisions on emotions rather than reason? No? Rationality implies that everything is reasoned out by us, and that's how we are making these decisions. But are we that rational, or are we making decisions on emotion, where loss aversion is a very strong sort of component? The problem is, when you make decisions on emotion, and of course everyone talks about greed and fear, but what happens is when you introduce emotions in your decision making, you also bring in biases that all of us have, these decisional biases or behavioral biases that we all have, and we make decisions based on these biases, and these decisions are not right. when we are making emotional decisions. So they lead to irrational decisions. And if you use rational models to to help people make decisions where their decision model is irrational, you're going to have problems. So you're going to have systematic problems or systemic problems or across the economy sort of problems. If everyone is irrational and they're all using models which are based on an assumption of rationality, how good are those decisions that are being made? So that's an issue. And we see this more and more from these expectational bubbles and crashes. Bubbles are a perfect example of a systemic bias in the investing population. If everyone behaves the same way, you're going to get bubbles. If everyone thinks that house prices will keep rising forever, that they'll never come down, you're going to get a real estate bubble. Same with .com and so on. Those are bubbles. Bubbles and crashes are very destructive for a capital market economy because of rational allocation and so on. I won't go into that today. But they are very destructive because they impede the production of wealth in the way that capital markets are supposed to. So in this, back to the case of biases, what prospect theory looks at is that what if we had biases, and if they entered the problem, what would rational models do to our decision making? So what I want to do next is to look at some common biases that afflict us, that affect our decision making, and it affects us in terms of what kind of returns we receive from our investment and so on. So let me give you sort of a brief overview of behavioral biases that enter into our decision making, which sort of suggest that we are not very rational. And I'll come back to that to see how systemic. At the end of these biases, you ask yourself, do I have even one of them? And if you even have one, you're probably making emotional decisions. I'm thinking that you'll say we are all irrational because these things are things that we are doing on a daily basis. And we are, I think so, in my opinion at least. So here's a bias which is called, it's a regret and pride bias, and I'll show you what this is. And these all come out of works done by academics, empirical and theoretical work done by academicians and academics, and so it's valid. They've looked at thousands of data points. So statistically, they're just as valid as modern portfolio theory or efficient market hypothesis, so that those people can't refute these results. Here's an example. Typically, we will hold losers longer than winners. All right? Typically, we'll lose losers longer than winners, 124 days versus 102 days. Now, think about it. You've bought two stocks. One after you bought started going up. One after you bought started going down. Now, you have to sell one of the two because you need some cash. Which one will you sell? And invariably, if you look at thousands of people, most people will sell the winner first and not the loser. Why? Because when you buy a stock and it goes up in price, you have a pride in your abilities. You feel you know something about stocks and picking stocks and making investment decisions and so on. So when you sell that stock, you're actually locking in your pride. You feel really good, you're locking in your pride. But it's the other way around with a loser. Once it's gone down, you don't want to sell it because the moment you sell that stock, you're actually going to lock in regret. Rather than cut your losses, you're going to lock in regret, and we don't want to lock in our regret. What are we going to do? Once it starts going down, we've all had it. If you say I didn't have it, I'm going to laugh at you. You can laugh at me too because I'm not going to say it either. It happens to all of us. You buy it, the stock goes down. What do? You think it's going to come down. It's going to come back. All right, so you hold it. You don't want to sell it. Then you hold it a bit longer, it goes down a bit longer, and you start saying, oh, I hope it comes down. And then, oh, I pray it comes down, come back, and when you sell it, it's too late sometimes. It's just too late, and we did not cut our losses in time. If you just turn this around, if you held the losers for 102 days, and you held the winners for 124 days, on an average, you'd make 4% more, about 4% more a year, just by holding losers shorter and winners longer. Buy and hold on the winners, cut your losses on the losers. Just by doing that consistently over time, you'll make 4% extra a year at least, if not more, if you can choose between the worst losers as such. And we do that. We always think that that they will come back, and we pray they'll come back and so on. Another one is over optimism and overconfidence, and they often work together with each other. If we were in a sort of a, well, let me ask you this question here. There's quite a few of you attending out here. So if I were to ask you and hit the checkbox for answers, if I were to ask you how many of you are good drivers, can you hit the checkbox? How many of you think you are good drivers? Go ahead. All right. All right. No more? Don't be shy. All right. About 80%, 75 to 80% of you are good drivers. But if you think about it, if I put you on a distribution chart, 50% of you are bad drivers. 50% are good drivers, right? There's a median in your class. Of those 75%, 25% of you would be in the poorer section of good drivers. But according to us, everyone is a good driver. If you ask college students how many of them are good drivers, 80% of them will say they're good drivers. So how does that work out in investments? If you have a good outcome, optimism says that's my skill. If it's a bad outcome, it's either bad luck or that your planners really doesn't know what to do. If it's a good outcome, it's the skill, or that's how they found you as an advisor. They are good at finding people who know their stuff. It's their skill. But if it's bad outcome, the planner's poor. Bad luck, the planner's poor. Overconfidence, how does that work? Forecasting how much a stock will change, in which direction. And in experiments they'll ask people, tell us, how much you think a stock will change, whatever stock, the stock they know the best. Tell us how much it will change by. Then the question is asked, how sure are you that you are correct? And they will give the answer, I'm 65%. On an average, they'll say, we're 65% sure that we are correct. In actuality, it turns out they're about 47% correct. So they are way overconfident about their abilities. And the expected return, now what this shows out here, the 30%, if you think about your estimate of being correct. So let's say I expect to be correct 50% of the time. Then my expected return is 0, right? 50% I'm correct, 50% I'm wrong. 50 minus 50 is 0. If I expect to be 52% of the time, 48% incorrect, then the difference of the two, 4%, is my expected return. Sort of like a rule of thumb. So if I expect to be correct 65% of the time, my expected return in my mind is about 30% on me being right about the magnitude and direction of price changes. 30% expected return is the amount of overconfidence shown by that estimate. Another way to think about it, how difficult is it to make 10% per year consistently? To get a return of 10% a year, you will have to be right just 55% of the time consistently. How difficult is it to be right 55% of the time is about as difficult to make 10% a year. And we know how difficult it is to make 10% a year consistently. That's how difficult it is to be right 55% of the time. All right. Lots of studies of how overconfidence, over-optimism works, and the best study was of the day traders in the tech.com time, where people who trade rapidly, they think they know something that no one else does. The millions of people were digging information, but the day traders know something that these millions of people don't know or cannot know. So they're selling and buying quickly. They know this one's going down, sell it, buy it, and they perceive that they have, superior information and so on. And invariably, these are the people who take the biggest hits. And of course, in this too, there's a definite gender bias within overconfidence and over optimism. And I'm sure you have an idea of which gender is more conservative, which is what's next, and who is more confident about their abilities. But here's the funny part. You would think married women, or this is an older study, so it's married women. It's a mature women, younger women, mature men, younger men. Yeah, instead of married men, substitute mature men and mature women instead of married women. And this is what this chart shows you is how often each group trade. And actually, this is funny when I first saw it, that single women actually are the most conservative. They trade the least. And of course, single men, everyone knows. I could have told you before, and you would have known that single men are the ones who are the most, cocky about their abilities and so on. However, this is the performance of the same group. The people who do the least trading have a return of about 18% on an average, and the people who do the most trading have a return of about 12% on an average. So single women beat single men about 6% a year, hands down. So, I mean, just think about that. I think I would be quite happy to give well, I'll qualify that, but if a young woman was making my money's investment decision, that's it. At least I wouldn't lose from overconfidence and over-optimism. That's a way of thinking about it. Of course, you need investment knowledge for that. But essentially, women are much more conservative and much less confident and optimistic about their knowledge about stocks and so on. But that actually really turns out to help them because they trade less, they buy and hold, and which is what is basically the same thing kind of behavior that's suggested by on theories in investment and finance. Here's another one, cognitive dissonance. These are all biases. And internal conflict when proven wrong about beliefs and assumptions. So if you believe something really strongly and you were proven wrong, you have a lot of problems about with yourself. There's a dissonance, and you have problems sort of telling yourself that you could be wrong. So, if you made decisions in the past that were wrong, that have been proven to be wrong, that actually can make you make worse decisions. That's sort of the thing because of the cognitive dissonance. And these are all coming out of psychology rather than finance, of course, as you understand. The finance people are learning about psychology, psychologists are learning about finance. And how does that work? The next chart will show us the results, I think, or it's somewhere later, but maybe it's now. No, it's here. So the question that was asked is like of two groups of people. One was architects. They're not technically savvy about investments, but they are educated people. And the other are AAII members. AAII stands for American Association of Individual Investors. And it's a very strong nationwide group, 150,000. It's the first, investment club. And there's about 150,000 people there nationwide. They're about 60 years old, most of them very educated. Average wealth is $1 million right now. So educated people, who think they understand the investments. So the architects were asked, how did you do in the last year? And then they looked at how they actually did. And they were asked to say how much how much did they outperform the markets by. And the architects basically said that they had made 4.62%. On an average, they had outperformed the market by. They had outperformed the market by about 6% or something, and it actually was 4.62. For the AI members, it was the other way around. They Their estimate was much more about how much they had outperformed the market than they had actually done so. So the Association of Individual Investors, their estimate of how much they had outperformed the market was way wrong as compared to architects, because these people think they know something about investments, and therefore they don't make mistakes. Their past investment mistakes were not registered in their minds because of their dissonance, and they were much more likely to make errors again. All right. The other one is a confirmation bias. There's another bias. Now, one of the things that you can ask yourself is, yeah, I do this, I do that, I do this, and you can start sort of saying, wow, I mean, we are students and we are knowledgeable about investments. We have some of these biases. Where are ordinary investors? How far are they? Confirmation bias, desire to find information that agrees with existing views. So let's say I come to you and say, hey, Charlie, what do you think about Yahoo stock or Microsoft stock? And I think that, Yahoo stock is going to go up to $120 or $150. And Charlie says, yeah, I think you're right, so it's going to go up to that high number. And let's say first Charlie says, no, I don't think you're right. I think you're wrong. It's not going to go up to $150. It's actually going to go more like to $50. And I just told Charlie that, Charlie, look, I think it's going to go up to $120. What do you think? And Charlie disagrees with me. And I say, Charlie, you don't know anything. Forget it. I'm not going to listen to you. You don't know what you're talking about. So then I go to Chris and I say, hey, Chris, what do you think about this? I think it's going to go to 120. And Chris says, yeah, I think you're right. I think it's going to go up that much, if not higher. And I say, yeah, that's actually right, because I'm also thinking it could go even up to 150. So if someone agrees with me, I will weigh that agreement at a much higher level than the one who disagrees with me. I'm seeking for confirmation that I'm right. So if anyone tells me I'm wrong, I'm going to underweigh that in my decision. Because I'm going to go ahead because someone agreed with me in making my decision. And it's got nothing to do about future cash flows and present values. It's about whether I'm right or wrong, and if someone agrees or disagrees with me. Another bias is anchoring, and anchoring is a bias that is very common for all of us. And I'm going to start with an example, and I'm going to ask you a question. So be prepared to write down some numbers on the chat box for you. So here, the question is, the Dow Jones Index started in 1896, and the original value of the index was 41. The index value was 41. In 1998, the Dow Jones Index value was 9,181. Now, as you may know, the Dow Jones, the dividends paid by the companies in the Dow 30 or whatever it was before, they are not included and they are not compounded. The value of the dividends are not compounded in the present value of the Dow Jones Index. So they are distributed and they don't go back into the index value. Suppose in 1998 that from 1896 to 1998, the dividends had been reinvested back into the Dow Jones. So instead of 9,181, how much do you think the Dow Jones would have been in 1998? Can you write down some numbers? Anyone? Open. Just guess. What do you think it would be? Go ahead. 20,000. All right. Someone else. 30,000. Anyone else? Go on. Go ahead. 2 million. Wow. Okay. 45,000. All right. Okay. So Steve is sort of trying to find something way outside, just to thinking that going contrarian. Who knows? 400,000, 150,000. But if you ask yourself, how are you getting these numbers? you'll look at that 9,181 and you'll say, it's in relation to that. 2 times, 3 times, 10 times. How much is that? 10 times is 100,000. Couldn't be more than 10 times. The actual number is 652,000. That's what the Dow Jones would have been in 1998. 652K if dividends had been reapplied. Now the point being that we are anchored to the number we see, and anchoring is a big issue in sort of negotiating prices. So in mergers and acquisitions, any form of negotiations on money, anchoring is big. It's sort of like when you bargain. I mean, let's go say you go to Tijuana and you are looking at something to buy. And this person comes and say, all right, you ask some guy on the street, how much did they want for something they're selling? And the person says, well, I want $100. And he said, come on, go ahead. What do you think I am? What kind of a sucker do you think I am? I'm not going to pay you $100 for this. And you bargain the guy down and you say, all right, $30, deal. You walk away with it, feeling on top of the world because you got that guy down by 70%. So it's from 100%, how much can you bring down? You are anchored to the 100. You actually came down at 30 and you say, I got a great deal at 30%. I got 70% discount. The guy on the other side of the border is saying, laughing at him, saying, oh, good gringo, come back. For that person, the buying price may have been $3. And they sold it for a 900% gain. And they're just laughing all the way to the bank. So anchoring works in the same way. When you look at a stock and you look at its price, and it's all right, this is $10 or $20 or $50. I'm going to make 12% return or 15% return, so it's going to go up to 60, 75. You are anchored to that $50 price. But efficient market theory says, hypothesis says, the current price includes everything. It's immaterial. It's of no use. But anchoring, a real bias, we are thinking in relation to the $50, how much the price would go. So in a bargain or an acquisition, merger and acquisition, the person who starts the pricing is actually trying to anchor the other person to a number. How meaningful that number is or meaningless is going to determine how tough the bargaining is going to be or the negotiation is going to be. And that's how this works out. And the current stock price is where we are anchored to, just like that 9,000 number. Representation heuristics. If you have good firms, so good firms must be good, bad firms must be bad. So buy the good firms, don't buy the bad firms. But all the indication is that they revert, mean reversion. So representation is what you see. This is what you see. Good company must be good stock. Poor company must be poor stock. So don't buy poor companies. It's actually the opposite. Poor companies will do well invariably. Good companies will do poorly invariably. So we have a behavioral bias built in. We are looking for good companies and good earnings, not poor companies and poor earnings, like the dogs of Dow essentially. And so we are always buying companies which are going to be losers in general. All right. Availability bias, sort of like, in this case, availability of information. Let's say tomorrow morning you wake up and everything is about some company, XYZ company. And, CNBC is talking about it, MSNBC is talking about it, Wall Street Journal is talking about it, Forbes, Business Week, everyone's saying how great a company it is. Are we going to buy that stock? Yes, many of us will. If it's the blogs that are talking about it, the newsletters talking about it, many of us will go and buy it. So there goes the present value of future cash flows out of the window because we are reacting to what we see in front of us. That's what we are reacting to. And when we do that, we are basically doing something. We are reacting to what we see in front of us and not what reason suggests. Go and look at the future cash flows, find the appropriate risk-adjusted discount rate, then find the present value of those future cash flows. That's the rational method. How many of us do that in anything that we are doing? So then, that's why we are coming to that question, how systemic is this problem or how deep is this problem? Here's another one, ambiguity bias. I think I'm going to go over 5. I hope you don't have too many problems with that, but I'll try and speed it. Uh, we like to invest in things we know. Familiarity bias is the opposite of ambiguity bias. We like to invest in things we know, and we don't like to invest in things we don't know about. So everyone has home country bias. So if you look at the value of the US stock market to the world stock markets, it's about 45%. So in any proper asset allocation decision, your allocation to US stocks would be about 45 to 50%, or close to that in an optimal asset allocation. But most of us have about 85% of our stocks in US assets, US stocks. In Japan, it's close to 97%. It's not just we, it's we in the whole universe. Everyone has this problem. These biases are across the board. They don't know national boundaries and stuff. We are all biased about our country because we know our country. This has problems. For example, retirement plan asset allocation. These are people, the people who manage retirement plans. They are CFAs and MBAs and PhDs. They have the bias too. I mean, in the late 90s, the British money managers in retirement plans, they had the most international stocks. They had about close to 20% international stock. It may be because of their wandering days. You know, they've been globetrotting for 300 years, so they are more open to sort of international investing, maybe something like that, working underneath. And you see that in Australians too, and so on. But you know, any rational model would suggest that our holdings of stocks and bonds international would be a lot more than 20%. But yet that's not the case. You see that example of Coca-Cola employees? 76% of Coca-Cola employees' stocks in their 401k plans are in Coca-Cola stock, and it's not required like as an Enron, you know. And 14% of Coca-Cola stock are owned by people who live in Atlanta. They know their company. This is their baby. They know Coca-Cola, so they all buy Coca-Cola. 14% of Coca-Cola stock are owned by people who live in Atlanta. Now that's incredible. I mean, there's nothing which should suggest that. Here's another very interesting observation. Mutual funds. The average holding of mutual funds, of the average holdings, 10% of mutual fund holdings are in companies which are in the same city as the mutual fund is located in. So if you're in LA, 10% of your funds will be in LA, of the stocks or the companies. Now, that's very strange, but the idea is, since these companies are in my city, I know them better than anyone else. Or if I'm in New York, I shouldn't buy in LA company stocks because I don't know LA company stocks. Now, that's ridiculous. But nonetheless, it exists. We like to invest in things we know about, and we dislike those we don't know about. And it shows up in our behavior. All right. So we are done with the biases, and I hope you can appreciate how the depth of biases in each of us and how irrational we may be in making our investment decisions. And you can say, I feel quite confident in saying that maybe 95% of us are irrational. And later on you'll say, but we put our money in mutual funds. They're CFAs and MBAs. They are rational, so we don't have to be rational. We just have to put in money in mutual funds, and we'll be safe. We'll see later on how that may not be the case. So a colleague of mine and actually a student of mine also, 3 of us, we did this study. And my colleague from he's in Scotland. He's in University in Aberdeen. He's a chair professor there. He and I, we started doing the study, and the student helped us actually, so we want to give him credit too. We did the study. We got some data from a company called Lipper. I don't know if you know about Lipper, but Lipper keeps track of mutual funds around the country, of all kinds of mutual funds. And they were very nice to share some data with us for this time period, 1993 to 2003, on various mutual funds, and we'll come to those soon. And this time period is really interesting because you have 3 distinct types of markets during this 10-year time period. 93 to 96 was a period of robust growth. 91 to 93 was a recession. mild recession. Then the economy turned around and it was robust. The growth was robust. 97 to 99 was boom, actually. That's the dot-com boom. So it was absolute boom. And then 2000 to 2003, as you know, was a bust period. The market tanked, and that was the bubble, the bursting of the dot-com bubble. Also, at the same point in time, if you look at from 1993, many of us were not, most people outside of academia were not using internet and email even in the early 90s. It came in the middle 90s that this started showing up. Using the internet, using email is not that old. It's about 10, 12 years old, even though we think it's been there forever. In the 80s, no one knew about all this stuff going on. Academics did. That's where that www comes from. So we used to use it, but most people didn't. But during this time, a tremendous amount of information has become available because of information technology. So the question that you want to ask is, all right, the access to information to anyone. I mean, how many times do we check our portfolios today? Which stock went up, which stock went down? What does this newsletter say? What does that blog say? We are absolutely inundated with information. Total overload. The question is, can we process this information in the same amount or at the same rate as the amount of information available? Has our ability to process information kept pace with our access to information? It hasn't. It hasn't. If anything, it's got worse because our ability to process information has not changed. The amount of information is overwhelming, so we are much more likely to make wrong decisions today because of information overload and because of lack of ability to process information than before the information revolution. And there is actually evidence to show this. This shows you the left side are people. This was before going online, before doing your trades now, going onto your E-Trade account or the Ameritrade account and doing a quick, snazzy trade. And then, before that, we had to call our brokers. I'm sure some of you remember it. I hope some of you remember it. I do. You have to call up your broker and say, all right, this is the ticker symbol, this is the stock, or find the ticker symbol for me. I want to buy 200 shares of this and so on. And then once internet came on, we could do it ourselves. There's cool $7 trades, $9 trades, so on. So before going online, this group of who was studied, they were making 18% market adjusted return before going online. And they were outperforming the market index by 2.35% before going online. After they went online, their returns reduced to 12%. They underperformed the market by 3.5%. So they lost about 6% because of going online. They, us, whoever. Because it's so easy to trade now. So much information, so easy to trade. But the point is, if you're irrational, you're going to make many more wrong trades. And it shows up right here in front of your eyes is the evidence that we are going to make many more wrong trades. So the objectives of our study was we wanted to compare what people did between these three time periods, look at investor trading behavior through the pattern of trading, from trading volume and dollar cash flow and so on. What were they doing during this time period? Remember also that 93 to 96, 96 to 90, 97 to 99, when the stock market was going up, the bond market was actually tanking. In 1998, a 10-year Treasury note had a return of about 8%. Now it's around 3.5%. Its long-term historical average rate is about 6%, or 5.5 to 6% is the 10-year Treasury rate. Right now it's at 3.5%. Since 2000, it's rarely gone over 4.5%. So it's way off its historical average. But during this time, 93 to 2000, it actually, the bond markets tanked. Then from 2000 to 2003, interest rates went down, bond markets peaked. So when the stock market peaked, the bond market fell apart. Then when the stock market fell apart, the bond market peaked from 2000 to 2003. So they did really the opposite, and we want to see what happens. The other thing to understand is that there's a life cycle hypothesis of investment. So generally, given the demographics, certain number of people are entering the marketplace. Most of them will put all their money in equity, small caps, then large caps. As they get older, they'll get into bonds. So we can follow from the demographics how much money on an average should be in bond funds, should be in stock funds, in balanced funds and income funds and so on. We can figure that out from the demographics and how people generally behave as they get older in time. All right. Okay. So the day we'll first look at price volume relations between the S&P 500 and the Nasdaq. Then we are going to go to the Lipper data, which is very rich data that they gave us. What they gave us, they divided the mutual funds into three groups: stock mutual funds, bond mutual funds, and balanced and income funds. But stock mutual funds are the most risky, with small cap stocks being the riskiest mutual funds. Balanced and income funds are somewhere in between. So they're a mix of bonds and stocks. And then you have bond funds, which are the safest. All right. What Lipper gave us was the net cash flow from each of these funds. How much was the net inflow? How much was the inflow into these mutual funds? How much was the outflow? What was the net funds? How many people subscribe to these funds? How many people redeem their funds on a monthly basis for the 10 years of this data? So the very, very rich data. We're going to look at these 3 time periods, and we are going to see how these net cash flows changed from growth period to boom period to bust period. All right? And instead of looking at statistics, I'm going to just show you pictures. They're much more powerful than statistics, but the statistics in a visual sense, but the statistics tell you the same story as what these pictures tell us. The bar lines are the index values. The dotted line out here, is trading volume. So you can see as the S&P goes up from January 93 till about, and it peaks around May through September 2000. As it goes up and it starts peaking, the volume of trading in S&P shares goes up steadily. You can see there's a strong correlation. But now look what happens when the S&P starts coming down. The volume doesn't come down. In fact, the volume goes up and hits higher and higher levels for quite a while. Now, who are these people who are buying? Some people are selling, of course, but selling at a point when the market's gone down. Buying at a point where the market's going to go down even further. People who couldn't get in earlier maybe, and they had regret, and now they say, oh, the market's come down a lot. Let's see some of this stock. Let me go and refinance that house of mine, take a cash out, and buy some stock. This is a good time. So Nasdaq's come down from 5,000 to say 3,000. You say, all right, 40% down. How much more can it come down? And look, this is the Nasdaq. Look at the trading. That's like feverish trading. That's wild speculation. That's your bubble. And the bubble bursting, while it's bursting, people are not realizing it. They're keeping on trading. They're buying it and they're selling it at the same time in the same amounts because they're thinking they're getting. So from 5,000, it comes down to 3,000. Look at the trading. It's peaked. It can't go down. It's gone down 40%. How much more can it go down? It went down to 1,000, 1,108 or something like that, or 1,098 or something. It went down another 40%, from 5,000 to 1,000. So people bought, at this point, look at the trading out here. This is the highest point, was about May and September. The amount of buying there was huge after that point. Huge amounts. People buying at the peak onwards is huge. Now, moving to the Lipper data in net cash flows. How did people behave? Now, remember this net cash flow, each of those bars are actually literally billions of dollars. Billions with a B as in oh boy. And it's like 60, 70 billion dollars, 150 billion dollars moving in or out of a type of fund in a single month. right? It's in a single month. Amounts of money is moving out, hundreds of billions of dollars. So look out here, between 93 to 99, generally people are investing in balanced funds. People are getting older, baby boomers are getting older, so putting their money in their retirement nest eggs, which mostly goes into balanced fund. But hey, look at what happens on September 99, January 2000 at the peak. Suddenly, remember, balanced funds are moderately safe, bond funds are safe, stock funds are risky. Small caps, riskiest, treasury bonds, safest. Balanced funds are somewhat in the middle, but they're safe funds. They produce income, they have bonds, so they're well diversified funds. Suddenly, at the peak of the stock market, people start taking this money out like crazy. All right? We don't know where this goes right now, but you can already start guessing. But they're taking out the money at the peak of the stock market craze. So they are selling at so in this case, they're selling the safe funds at the highest points. All right? We want to see where they're buying. Remember, the bond market is at the bottom. So they're selling it at the bottom of the bond market, so at the lowest price for the bonds in the balanced funds. Then from January 2001 through September 2003, they're buying back in huge amounts when the bond market is peaking. All right? So we want to see where these monies go in. Next one is large cap funds, cash flows. All right? The large cap funds, if you see till about 98, is pretty much moderate. All right? Large cap funds, this is how much people invest in. Generally, mid-career people investing, moving from small caps to S&P 500 kind of funds. Now look at what happens at the peak. September 99 it peaks, and after that, look at how much money moved into large cap funds when the market is tanking. All right. So that balanced fund, that money that was coming out, was going into the stock market at the peak of the stock market. That's at the peak. Then, when the market is tanked out, people are selling stocks because they're saying, I can't hold on to this loss. I want to get out of this. So they're buying at the top, selling at the bottom. You want to buy low, sell high, right? But this shows you, or this and the last one, that people are buying high, selling low. Not only that, you see it over and over again. Saw the balanced funds. You're seeing this large cap fund. This is buying at the peak, at the highest, selling at the bottom, at the lowest. Mid cap fund. This one is a strange one because you can see most of the money is going in after the large caps and the small caps have known to have crashed. Now my people are buying mid caps because they're saying, well, no one bought mid caps till now. It was all large and small caps. Maybe we can make some extra money in mid caps. So all the money went into it. Even that started crashing at that point. Small caps. Look at small caps. This is after the peak. Most of the money is going in right at the peak and after. So people are buying at the top of the market. Right at the top of the market, they're buying. And as it crashes, they're buying more and more. More and more money is going in here. We saw it came out of the balance fund. We'll see it comes out of the income funds. So people are taking money out of safe funds and putting it into risky funds. They're taking out of money in safe funds when it's low priced, putting it into risky funds when they are high priced. Selling low, buying high. Then look from 2001 to 2003. They're buying this when the bond market is at their peak. You'll see this is the same thing in the bond market. Look at the bond market. How much people bought at the peak of the bond market? It's still at the peak. And I've heard so many anecdotal stories about people after 2000. They're just basically saying, I don't want to be in stocks. Get me out of stocks. Get me into bonds. So they won't even let like long-term, stock returns are over long-term. So only if you hold them long-term do you realize the higher rates. If you panic and you sell out, you're setting yourself back in a big sort of way. So that's why after that tech bubble burst, the retirement lives of Americans went, expected retirement day went from about 65 to 72. 5 to 7 years. People are studying right now Financial planners are doing studies on how do we stay healthy because we need to be working till 72. But what we need to look at is how did we get there in the first place? We got here because of this behavioral thing. People are taking money out of their retirement nest eggs because their neighbor was saying, what, you made 6% last year? I made 50% last month. What are you doing? Get rid of your plan and come with me. I'll show you how to do it. I'll show you how to make that money. General bond funds. And, the story goes on. Same thing. Take the money out of safe funds when it's at their bottom and put it in when it's at the top. Where were you, when you were taking out this money, where were you putting it in? In stock funds. This is in real estate funds. Again, exact same market. Take it out when it's low priced, put it back in with its high priced. So, in conclusion, we can, this is the academic in me. We seem to systemically behave irrationally. I don't want to say we do, but we seem to. It's the data suggests that we exhibit signs of bias, of herding behavior, overconfidence, gambling behavior. We appear to be influenced by fads and bubbles. We appear to be working together, and this information age is making us more so because information is traveling right now at nano speed. If someone starts buying Microsoft somewhere and gets onto the blogs and the news wires and stuff, everyone knows about it, everyone starts buying it. Forget the future cash flows and the present values. That's all out of out of the window. And actually, this has an impact on our children because they're going to inherit some of the problems that we're introducing here because we're abandoning our long-term goals. We're not saying, I've got stocks. It's going to make me 12% only if I stay in it for 15, 20 years, at least 2 business cycles, if not longer. So if the moment it goes down, I take it out, I'm setting myself back many, many years back if I'm selling on panic and fear. So if we do that and we get out, then when the market comes back, we don't have our position in the stock. We can't make that 12% average return in stocks. We've actually set ourselves back 5 years, 10 years because we are panicking and we are behaving the way we shouldn't behave. You look at this picture, and the question, of course, is which line is bigger? And you know the answer. And I think if I were to ask you, you'd say they're both the same. And that's true. All right. Knowing that the 2 lines are same, does that change the illusion that one looks bigger than the other? No, it doesn't. The top line still looks bigger than the bottom line. So even when we know we have a bias, we don't do anything about it. That's the point of this picture. Is that even though we know that we behave like this, we are not very capable of changing it. So from a planner's point of view, you got to start understanding what you're facing with. And of course, charity begins at home. We need to start studying ourselves as to what we need to change before we can start thinking about how we can help our clients change. So that's the point of that picture. Now, earlier I had said that, that we don't have to worry about rationality. Our money is being managed by CFPs and PhDs and CFAs and the money managers who are very well educated. Here's sort of why that doesn't work, and I'll give you an analogy with medicine. If you look at all the popular journals, like, magazines and stuff, like whether it's Business Week or it's, food and gourmet food or Sunset Magazine or Home and Garden, in any of these journals, you'll see a tremendous amount of advertisements for medicine. I have seen all these Vioxx and Botox and Clorox, I don't know what, but tons and tons of ads about medicine. What kind of symptoms do these medicines, can these medicines help to cure? What kind of ailments? Now, in this country, to become a doctor after high school, you have to go to school, doctor school for at least 12 years. To become a specialist, you have to go to school for 15 years to become a doctor. Now, if I'm told that this is the medicine for these symptoms, and if I have this symptom, I'm going to self-diagnose, and I'm going to say, hey, I want to try this medicine. I'm going to go to the doctor, and I'm going to say, give me this medicine, prescribe this to me. What if the doctor says, no, this is not yours? Even though they've studied 15 years, you don't have 5 minutes worth of knowledge about the medicine. You will say, well, you won't prescribe it to me, I'll go to someone else. The good doctor will say, that's fine. This is my diagnosis. You don't need it. I've got 15 years of education, maybe 20 years of experience. If you don't want to listen to me, you don't want your medicine to be better, then go to somewhere else. Well, if I go to somewhere else, I'll keep going to somewhere else till I find someone who will give me that medicine. It works the same way in investments. If you follow trading in the markets, go look at the amount of trading before each quarter. You will see trading is heightened before each end of quarter, not quarter, each end of quarter. Why does trading suddenly jump at the end of each quarter? Because the rules, the SEC rules of disclosure are, you have to show your clients in your mutual funds what your mutual fund holdings are only on the day of closing of a mutual fund. All right? So in the last quarter, if IBM went up a lot, right near the end of that quarter, if I didn't own IBM, I'll just buy IBM, a lot of IBM. I'll sell whatever is lost so that when the quarter ends, I show my chart. You won't look at what they did only, but you'll say, hey, did you have IBM? Or I might say, we have IBM. And we didn't, you're not going to say we didn't have something. We say, we are all the ones which won. That's called window dressing. Otherwise, what will you do? You'll go to another doctor, another investment manager, because your guy doesn't know what to do. It's called window dressing. And they're doing the same thing because to keep the clients. So they're pandering to you, and the marketing people are taking all of us for a ride. I mean, what business do we have to know what medicine works for what? We're not doctors. It's like sort of saying, let's say I've got a pain in my, right near here, which could be an appendix. And I think, yeah, it's an appendix. I go to the Rite Aid, in my neighborhood Rite Aid, pick up a do-it-yourself appendicitis box, surgery box, call up my doctor and say, all right, where do I start cutting up? We don't do that. But that's what it amounts to. When someone tells us this is the pill for us because of these symptoms, we do the diagnosis and we'll follow through with it till we find that doctor. So from a planner's implication, you can understand why it's important for you to understand. It's sort of like, it's axiomatic that we are not rational, we are irrational. And our models of investment are based on rationality. What kind of problems are we going to see? Implications for these new theories. One of the things that behavioral finance is saying is that maybe it's the behavioral side of finance which can explain technical analysis because nothing else does. Technical analysis is mindless. For the first time, technical analysts are saying, hey, we could be right. Our mumbo jumbo, sort of like, voodoo economics is coming out to be right. And so behavioral economics might be because, think about it. Let's say yesterday was the end of the quarter, all right? Let's say small caps had a wonderful year, a wonderful quarter. Are we going to buy a lot of small caps tomorrow? Absolutely. We're going to look at the past to make our decision as a whole. All the newsletters, all the blogs will be awash with information of how great small cap stocks did. But what happens to the idea that whatever is in the past is contained in the price in the present, which is what efficient market hypothesis suggests. And as risk-averse investors, we should not be chasing returns. That's risk neutral, not risk averse. We should be looking at both upside and downside, not just return chasing behavior, but we have to be risk aware too. But if you look at the past and look at the returns, we're chasing returns. That's risk neutral behavior. We're supposed to be 95% are supposed to be risk averse. 95% of us are behaving as if we are risk neutral. So from the point of view, it's not like which way the market is going to go because everyone's going to go that way. It's basically to be that good doctor, your financial health practitioners. You have to be the good doctor to tell your client, and you may lose a client or two, is that, look, all I can do, diagnose from your position, is that you should not be doing this. You should be doing this. You may not like my medicine, And if you feel that you have to leave, that's okay, but I cannot give you bad advice. And in the long run, it's that consistency that shows up. And so the best planners are the ones who can bring discipline into in lives of their planners. But you start with yourself. It's the new planner. And then you should think about the good doctor. So you think of yourself as financial health practitioners. So we need to be not only competent and ethical, but we need to be educated because we need to understand psychology. You need to be careful about not trying to modify behavior because we are not psychologists, we are not counselors, but we need to be able to understand so that we can refer a client and say, hey, that's a lot like gambling behavior. And we should start thinking about maybe getting some counseling. And I know I have a good friend who's a counselor, but we should not try to modify behavior because we are not qualified to. We need to understand the symptoms of these biases, first with us and then with our clients. So, for example, the consumption that we see around us compared to savings and debt, that's an indication of these biases. Return chasing, gambling behavior. DC plans, opt-in, opt-out. I don't know if you know about it. In the defined contribution plans, if employees have to opt in, 40% won't opt in, saying they need the money, they can't save, even though the company have matching up to 6%, 10%, so they walk away from free money. If you make it opt out, 10% will opt out. So that's why in the 2006 Pension Protection Act, they made opt-in, opt-out the rule rather than opt-in. And they're looking at inert investors so that they don't have to make their own decisions. They can have better planners and investors making the decision because they'll walk away from free money. So for you, you need to understand the implications of that. So these are difficult things. So what I do when I present on my work, I tell financial planners that you're financial health practitioners. You're looking at the personal financial health of your clients. So you are going to be just like doctors or financial doctors. So there are things like diet and exercise. Everyone understands that good diet and good exercise is good for your body and your mind. What are the good diets and exercises of financial health? One thing, reasonable expectations. The highest expectation that one should have of returns, maybe a 25, 30-year-old, fresh in career, extremely aggressive, is 15%. That's the most aggressive, youngest investor. The most common is 8 to 12%. If you save early and save often, which is the other part, that's another exercise, the power of compounding doing the rest, 8 to 12% for most cases is more than return. If you do 8 to 12% over 30, 40 years, it takes care of all your problems in terms of investment. If you save early and you save often, that's sort of like the diet and exercise. Save, do not consume more than you earn, which is what we are doing right now. Negative savings. Save, Americans in the 70s on an average saved about 8 to 10%. Last year it was negative 1%. Intervention, yes, sometimes it's necessary to intervene, but not yourself. You need to figure out counselors who can help your clients with intervention and so on. So financial health is a prerequisite, as I say, to mental and then physical health. The reverse is true. How many people have you met? And there's a lot of people in very, very poor financial health right now. How many of them are happy? So if you're in the 50s and you have nothing in your retirement funds and you're going to retire, you're getting depressed, you're going to get depressed and you go to a doctor and you get into the antidepressant pills. So it's also related to that. If you're in good financial health, that will not be a reason to be in poor mental health. So it's a necessary condition, at least. It's not the only reason you can be in poor mental health, but it's definitely one condition. So the reverse is true as well. So in this case, think about it. 1 million people are turning baby boomers from last year, every year for the next 20 years. On an average, they'll have $200,000 in their 401k plan. $200,000. Employee Benefits Research Institute work. $200,000 at 6%, that's a safe rate, is $12,000 per year, plus say Social Security, another $12,000. $25,000 a year and they are spending $75,000, $80,000, and they will get $25,000 when they retire. And even then, they'll take that $200,000 in a lump sum, buy a Cadillac for $30,000 or $40,000. First thing they'll do. That's the amount of poor health, financial health, which is why it's so important for you guys to sort of get up and about and say, we need to do something about it because you're the doctors. What are the issues? Trust, sticking to goals and consistency, educating yourself, doctor heal thyself sort of thing. Understand what the behavioral issues are. Need to emphasize the importance of discipline. Bring discipline into your clients. Educate yourself. That's how you get trust. Sticking to goals. When the markets go down, don't tell someone to sell their stocks and buy bonds. So no, you are in this for 30 years. This is your retirement plan. That's 3 business cycles. If you hold it for 30 years, you will make 12%. But if you panic, you're going to set yourself back. Sticking to goals and consistency. Over time, when your clients see that this works, listening to you works, and the trust has been built, that's all you need to be a good planner. They'll bring all the clients you can handle. So in the long run, the short run, it can be tough because clients can leave you, especially if you're sort of, at the point of starting your practices. So it's really important that you understand that.